The import of this result can't be overstated. It's immense because for the past 3 years, we have had an open border and letting millions, if not tens of millions, of completely unvetted people into the country, a lot of whom were military-age men, also a lot of whom were unaccompanied children who got sent right into this sex trafficking system that we have in the U.S. So that was a nightmare. We were also blundering into World War III, where, potentially we had 3 different flashpoints in the world, China, Iran, and Russia, where we could, on any given day, be in a shooting war, which could metastasize into something else. So there was that. And then we were drifting into authoritarianism, where censorship seemed to be the policy of the establishment. They wanted to stamp out any kind of dissenting speech. So we were drifting into that kind of a dictatorship. Now, post-election, that's all mostly gone. We're probably going to manage our geopolitics better. And there's a decent chance that we step back from the World War III precipice where we were. The border is probably going to get shut down and controlled, and censorship is less likely now in most areas of public discourse. So we're not going to become dictatorship in the short run. So all of that is taken care of. And I think the financial markets, we're looking at all of those things going into the election. That's part of why gold went up the way it did, and part of why there was an expectation of the Fed easing aggressively because they didn't want to be tight going into World War III and all the rest of this stuff. So you take away the non-financial aspects of people's anxiety, and you get the world that you and I used to talk about, Donegan. Remember when a big financial crisis was really the thing, and we didn't have all this other stuff to worry about? And there's a chance that we're heading back into that kind of world, only with the financial crisis much, much worse, because we've, in the intervening 5 years, taken on immense amounts of new debt. There's absolutely no way to control government spending, even though the new administration is going to attempt it. But interest costs on the government debt is now bigger than the military budget. Baby boomers are retiring, so it's going to cost trillions and trillions of extra dollars to take care of us, give us all our hip replacements and, heart surgeries and things like that we have been promised by previous administrations. So we've got that financial crisis coming still. And the question of timing is that, will the financial markets be very optimistic because we got rid of all that other stuff? And will we still have a bull market in equities for a while? And will bonds be well behaved? And will precious metals not be perceived as that necessary because you don't need hedges against chaos if you're not heading into chaos? So it'll be eventually perceived that we are heading into chaos, and then we'll go back to inflation hedge friendly market sooner rather than later. I don't want to be too pessimistic about what's going on right now because lots of good things are being proposed by the incoming government. The stuff that Kennedy's going to do in the health sector is mostly very exciting, And the idea of Elon Musk and Vivek Ramaswamy heading up a quasi-government group that's going to look at ways to make the government more efficient, that's also excellent. There's an awful lot of things you could do that would allow you in a government like ours to get rid of, say, a third of the people who work for the government at any given time. And that's awesome, because you can replace people with technology in bureaucracies in ways that the bureaucracies themselves don't recognize until somebody on the outside comes in and does it for them. So, I think that's all possible, and it's going to be fun to watch. Oh, and we could also make peace with a lot of countries that we've antagonized in the past. All of this would be excellent. But it doesn't change the fact that boomers are retiring. So we have trillions of extra dollars that have to go to my generation. We have $35 trillion and rising of debt already borrowed by the federal government. So the interest cost on that debt is spiraling out of control now. It's parabolic and continuing to go straight up. And stuff like that can't be fixed if you don't just take a meat axe to government spending. And, we're not going to do that. We're not going to cut Medicare. That's politically impossible. Social Security, politically impossible. The defense budget, I wouldn't call that politically impossible, but the guys in charge that even Trump is putting in charge right now are never going to stand for, 1/3 cut in the military budget. The Fed started a new easing cycle here. They cut interest rates by 50 basis points, then another 25 basis points. And you would expect if the Fed can control interest rates, that long-term interest rates would start going down once the Fed starts cutting short-term interest rates. That didn't happen this time. bond yields, especially the 10-year Treasury, which everything keys off of, bottomed just before the Fed started cutting and has been going up ever since. So in effect, monetary policy is tightening, no matter what the Fed is talking about now, and until they go back to QE and they start buying long-term bonds with newly created currency. But can they really do that? Because we found out what happens when you flood the system with new currency in 2021, 22. We ended up with double-digit inflation in 2022, and people know that's possible now. It's in short-term living memory for most of the country. So if the government tries that again, in other words, tries aggressively to push down interest rates by creating a lot of new dollars and dumping them into the banking system, we're liable to see everybody front-run that this time. In other words, they see the conditions are being created for another bout of inflation, so everybody panic buys everything, which sounds suspiciously like the Austrian economics crack-up. There doesn't seem to be another scenario in which the Fed aggressively tries to get a grip on interest rates. And if they don't do that, then interest rates are going to stay high enough to bankrupt all kinds of entities out there. Commercial real estate, housing, it's already pretty much frozen in the US because house prices are unaffordable for the average person. So hardly anybody can buy a house now. And you need either falling house prices or falling mortgage rates. Well, if we don't get falling mortgage rates because bond yields are going up and that's pulling mortgage rates upward, then nobody's going to buy houses. And we're seeing a lot of new inventory come onto the market right now. So if that inventory has to sell, which a lot of it will have to sell, it means house prices have to tank. So there's one recessionary indicator right there, you know? You can look around at other parts of the economy and find similar stories where an awful lot of things are pointing towards a recession unless interest rates plunge from here. And the only way to make them plunge is to risk another bout of serious inflation and all the knock-on effects that implies. So we're kind of in that box, Dunnigan, where the Fed has no way out and they can only choose one crisis or another. You know, there's no organically growing, healthy economy that can flow from where we are now. There has to be some kind of a crisis that incents us to fix the system. So, you know, I think this administration is uniquely qualified to do that because they're already making really aggressive steps to fix a lot of other things. So it could be that we may end up turning them loose on the monetary system at some point and seeing what they come up with. But there's got to be a crisis first. So the whole dollar collapse scenario took way longer than it should have to play out, but it is playing out according to the script. It's just that each act in the play, we can expect the current one to take longer too, I guess. But we are headed in that direction. You and I have talked about office buildings a few times, and so a lot of your listeners will know the story that I'm going to tell, so I'll keep it nice and brief. But a lot of office buildings went up in the previous decade, financed with super cheap money. Now, interest rates are up, so those buildings might have to be refinanced at higher interest rates. And at the same time, during the pandemic, a lot of people figured out that they don't like to work in offices, they want to work at home. So offices aren't as full as they used to be. So their cash flow is down and their interest costs are going up. A lot of these buildings just can't make it. They're either going to declare bankruptcy or they're going to be sold at much, much lower prices, both of which produce losses on the paper that was taken out in order to build these buildings. So a lot of that paper is sitting on the balance sheets of local and regional banks. And so they're going to have to take big losses that they report. Instead of just having it be unrealized, it's going to have to be realized and reported. That's going to scare their depositors who pull their money out, and that's going to bust a lot of these banks. You know, we'll have runs, a lot of local and regional banks, which spread to the other local and regional banks. And, you know, we're talking several $1 trillion here. So the federal government will have to step in and bail them out. And then what does that do to the dollar if everybody's watching a gigantic bailout, you know, and wonders what the implications are? Okay, that's commercial real estate. And then you've got the Airbnb guys who built little real estate empires over the past decade of, you know, a couple of apartment buildings here, maybe a house or two there, all financed on the assumption that cash flow would be sufficient to cover the interest costs. Well, that's not happening for a lot of them. So they're going to have to dump a lot of their properties or go bankrupt and then have the bankruptcy court handle that. The banks take them back and everything. So that's another big source of inventory. And then Wall Street. They turned out to be the biggest landlords in the country in the last decade. when private equity guys just went around and bought up entire neighborhoods for 20% over the asking price. And now asking prices like that are nowhere to be found, or nobody can pay them. So prices are going down, which is screwing with the projections of these hedge funds and private equity guys, because now they're not making nearly as much money as they thought they would. And we know from our lived history that when Wall Street finds out that a bubble is not working, they panic sell. They just bail on that thing, everything falls apart. And that's housing now for the first time ever. We never had Wall Street treat houses like a speculative asset and jump in, and they're going to have to jump back out because that's what they always do when a bubble bursts. So massive housing inventory out there waiting to be dumped on the market, and let interest rates go up a little bit from here, and that might be the catalyst. If people conclude that they're never going to see cheaper interest rates again so they can never refinance, that leads people who might be on the fence about whether to sell or not to say, oh, and plus, the cost of maintaining a house has gone through the roof. Homeowners insurance and taxes are both way up in a lot of places for houses. So the cost of staying in your house, if you're on the fence, is suddenly much higher than it used to be. So you've got your physical health, the trend in the asset value that you own, and day-to-day costs, maintenance costs going way up. So there are a lot of reasons that you want to bail. And if you're a baby boomer or a Airbnb guy or a private equity landlord, all of those reasons are piling up. They're going to become undeniable in the not too distant future. So housing is going to tank. That was a long one. But the point is that home prices have to fall by 40% if interest rates don't. And if you're in a house now and you're looking at that prospect, maybe you want to sell now for 20% under the current market, because that gets you out and saves you the extra 20% if the house falls by 40%. So expect that to kind of dominate homeowner psychology for the next few years. Well, gold and silver were always vulnerable to an equities bear market, because the way it has worked the last couple of times is stocks tank, and then that pulls down gold and silver, and then it's kind of a V bottom. The Fed steps in, starts liquefying everything in sight, and then gold and silver just rocket. So that kind of a scenario is possible, if not likely, over the next couple of years, and we have to have that equities bear market first. So that's a thing to worry about with precious metals, but not seriously. Just dollar cost average. Don't try and time these markets, because smarter people and smarter computers than us are trying to do the same thing, and it's hard to compete with them. And what's happened just recently, I think a part of that is because built into the gold price, which was extremely high, was a lot of anxiety about World War III and dictatorship and open borders, that stuff. So you had the monetary worries that are normal that elevate gold and silver, but you had all this other stuff that people were worried about too. So this election took some of that away. So it's normal to expect that part of the risk premium in gold and silver to evaporate if those risks have evaporated. They haven't evaporated yet, but they've been lessened to the point where it impacts safe haven assets. So that's to be expected. And none of this stuff affects the long-term prognosis for gold and silver. We've taken on more debt than we can ever manage without some kind of a gigantic crisis. We have to deal with that. And that's going to be a very good time for precious metals, because the Fed will conclude that the only way to deal with the debt is to inflate away the currency, and that's a great environment for precious metals. So we'll see that. That's coming. But, and there's one other aspect to this that I might be giving Trump and his people too much credit, but it seems like it's conceivable that they might actually just do something like go back to a gold standard, before we hit rock bottom. And the Fed, buy gold, and it's possible that they just come out with that sometime, some Sunday night, and that would be great. That would still be great for gold bugs, because you would have to do it at a gold price of $10,000 or more per ounce. In other words, you'd have to devalue the dollar that much to make going back to a gold standard technically possible. So it could be that people with a lot of gold just wake up one morning and find their gold stack revalued by 2 or 3 times. But in any event, gold and silver will do just fine in what's coming.